Good morning, everyone. Welcome to Canadian Mortgage Weekly today for October 13th at 11:30 a.m. with your host, 𝗪𝗠𝗘. I'm excited to be here today for episode 102. We've been here for quite a while doing this show now. And today we're going to be talking about 5 ways to afford more home in this market. And I have some really awesome strategies to help you all to be able to afford more home in this market. As I know, we are getting a lot of clients calling in these days. They have good jobs, they have good credit, very little debt, and they're just not able to afford the average home in today's market, which is getting a little bit frustrating for our clients. And it's also frustrating to us because we see that these clients are mortgage ready. They are able to get approved for a mortgage. It's just not enough to buy the house that they're looking for. And sometimes not even enough to buy any house at all in this market. And that can be concerning, especially if you're a new homeowner, first-time buyer that has been saving for quite a few years, getting your down payment ready, skimping on a lot of things, and just making sure that you're saving and hunkering down and putting that down payment aside. Maybe you've even reached out to your family and your family's ready to help you with a down payment on a house, but you just can't afford anything out there because the banks are saying, you can't afford much at all. And you go out there with your real estate agent and there's not really much out there in your price range. Perhaps you've even sold a home that you sold for hundreds of thousands of dollars and now you can't get back in the market because the home you once were in, you can't afford it now based on the mortgage rules and qualifying rules in today's Canadian mortgage marketplace. So today, my name is 𝗪𝗠𝗘, and I have some strategies that I'm going to share with you all in terms of how you can afford more home. 5 strategies that you can use to afford more home. Why am I doing this? I'm doing this so we can get clients into the home they want rather than them just waiting along the sidelines. This is a great time to get in the market. House prices have come down quite significantly, which is a great time to get in for a lot of people because they're going to have a much lower down payment versus they would have in February when the prices were a lot higher, or they're going to just be able to have a lot less mortgage as well because the prices are lower now than they were in February. So I'm doing it just to help people get in the market. And I'm hoping this is useful because for a lot of folks out there, maybe you don't know that these simple strategies can help you get a better home or more home or even just get you into the market today. So maybe these simple strategies will help you just get right into the market. And we'll see how people respond. I know on our end, when we tell our clients these strategies, when we have the appointment with our clients to be able to get pre-approved, a lot of our clients are grateful. They usually take advantage of some of these strategies to afford more home. I know we have a few clients right now that are going through this process and they've taken advantage of some of these strategies and they're working on getting the strategies running so they can afford more home. So I'm going to share those strategies with you. And the financial impacts these strategies can have is they could possibly get you a lower interest rate, lower payments, more mortgage money, and get you into that home that you need right now versus not getting into a home and renting for a longer period of time, or getting you into a home that you're going to have to sell anyway down the road, which, as you know, if you sell a home, you have to pay real estate, legal fees, all of that. So you want to avoid that as much as possible and get into the home you want right now. And, I'm hoping people can use these guidelines and strategies to their benefit to get into the market. And with these strategies, I hope that you can share them with your friends and family so they can use these strategies as well. That you can share some of these great ideas to get them into the market. And, in the future, I'm not sure if the government's going to intervene with helping Canadian homeowners get into a home faster or even get into a home in any more sort of way than they already are. So knowing these strategies really is going to help our wannabe homeowners or second homeowners or third-time homeowners get into the house they want today So let's get into what people should be doing to get more home in today's market. As we know, the rates are higher, and because the rates are higher, the government has mandated all mortgage lenders to qualify at a mortgage rate that is 2% higher than the rate you're getting. So already right there, that mortgage stress test is really limiting a lot of qualifying room for a lot of our clients out there. So what can people do? Well, first off, if you're buying a home or getting into buying a home, either you're selling your current home or you're a first-time home buyer and you have any sort of debt, it's not a bad thing to have debt. A lot of the times you can still buy a home with some credit card debt or an OSAP loan. We've seen that happen before. But if you have a car loan, for example, or you're planning to get a new car and get a car loan, I highly suggest you look at paying off the car loan, because a car payment, whether it's $300 biweekly or $400 biweekly, it can have a severe and catastrophic impact on your mortgage qualifying these days. A biweekly payment of about $400 can limit your qualifying. Sometimes I've seen by $100,000 to $200,000 on your mortgage, depending on where you're sitting at with your income and other debts. So just having a car loan of that size, you may not think it's much and you can handle it and the mortgage payment because you're handling rent that way or your current mortgage payment that way. But with the strict qualifying ratios out there, the lenders are really qualifying everyone with this stress test. And having a car payment of $300 or $400 biweekly, is really going to limit the amount you can borrow. So if you can find some way of paying off this loan, whether it is through family helping you out and just covering that loan for you, or you have a friend that you can get them to pay off the car, or you can sell the car. A lot of the times we recommend selling your vehicle with a car loan and buy a late model vehicle just to get you into the house. And then once you have your mortgage and you're paying those mortgage payments, you can then go out and buy yourself a car and get a car loan if you so desire to do that. And just by paying off that $300 or $400 biweekly car loan payment, you're going to own your car outright, which is going to be great for you. And you'll be able to also qualify for about $100,000 to $200,000 more on your home. So that's number one, first thing someone can do to qualify for more home. Second thing people can do is also not something people want to do, but in this market, because interest rates are so much higher, and to take advantage of these lower home prices, you might want to get a second job. And that could be either a side hustle that you're doing, a self-employed side hustle that's earning you an income, or part-time employment position that is earning you a steady amount of hours each week on top of your current position. So by adding $10,000 to $20,000 a year in income to your overall profile can really significantly impact your mortgage qualifying. I've seen people get a part-time job that pays around $20,000 a year, and they can all of a sudden afford about $90,000 to $100,000 more mortgage. And that all depends also on your current profile, credit, and income data. But that's what I see on average. So number two would be second job. And then once you get into that home and you have that mortgage and you're paying that second mortgage and you feel comfortable with that, it's up to you if you keep that second job or not. But just getting into the market, having that second job can really give you a leg up compared to a lot of other home buyers that are out there today. Please contact me if you are looking at getting a second position so I can guide you with some of the nuances that lenders want to see on that second position, especially if it's a part-time or self-employed position. Number three, so those are the first two, paying off debt and getting a second job. And number three is getting a cosigner. So a lot of people don't like getting cosigners because they want to get into the market on their own. But adding a cosigner like a family member, such as a mom or a dad, that's even earning a pension income, for example, can really help boost your qualifying with the bank. A lot of moms and dads or grandpas and grandmas are on pensions these days. Maybe they're earning a pension from their employer of about 40 or 50,000. Maybe they're also earning a CPP pension from Canadian Pension Plan. And maybe they're lucky enough to also be in that old age security bracket where they're earning a third income that way. So that could be an additional $60,000, $70,000 that we can add to your mortgage application from that one parent or grandparent that can really boost you up that way. And we've seen people qualify for much more mortgage money that way and just be able to get into their home that way. And the idea is you get into the market that way, you'll have that co-signer, and then we can look at removing that co-signer down the road once we see that we can qualify on your own. And usually that happens when you show that you've built some equity in the home, you've also got a raise or more income coming in under your own names, and you've also improved your credit. So all those are taken into account when we look at removing your cosigner down the road. And it's not a permanent thing. We can even remove a cosigner midway through a 5-year fixed term, which can really benefit you if you want to keep that rate and not break that mortgage midway through. So those are the first 3 items you can do to afford more home. Number 4 would be if you're buying your first home or second home, a lot of people like to do the minimum down payment and keep the rest of the money aside for themselves, like 5% down or 10% down. But a good way to afford more home is actually putting 20% or more down payment. And what this does is you can get around a lot of the CMHC or Sagan or Canada Guarantee rules. And that's mortgage insurance that is required for all mortgages with less than 20% down. And if you can get around those rules, then all of a sudden you're opened up to a slew of more lenders. You have better qualifying ratios, you have better amortization periods available for you, and less strict requirements on some of the way that the mortgage is qualified through each lender. And you also are open to a lot of alternative lenders at that moment in time too. So just by having 20% down, that can really put your mortgage application forward and be able also to lower the mortgage payments on that mortgage you're getting. So something to really consider is getting 20% down. Perhaps you can find more down payment by saving it, or I know 20% is really hard, but you can get family to gift you additional down payment. Things like that can really increase the amount you qualify for on a mortgage. All right, so those are the first 4 things. Number 5, and then we have a bonus one here today as well. So number 5 would be higher amortization periods. So if you're looking to pay off your mortgage, say in 20 years, the bank's actually going to qualify you on that payment for the 20-year mortgage. So by qualifying for a mortgage over 20 years, you're really going to limit yourself at how much you can qualify for on your house. So by increasing your amortization to 25 or 30 years, or even there's a lot of lenders out there now that are offering 40-year amortizations, you can bring that payment down right now and afford much more home. And that just gives you the advantage of just getting into the market now. And a lot of these lenders, they also offer prepayment privileges, which if you want to lower your amortization back down, you can take advantage of these prepayment privileges, which will lower your amortization. And, after you get into the market, and put you at, say, 30 or 25 years again after taking a 40-year mortgage. So you don't have to be stuck in that 40-year repayment cycle for the full length of the mortgage. Give me a call. We can work out this strategy together. Just book an appointment through the link below, and we can do it that way. So that's the first 5 things. Number 6, we have a bonus one today. And a lot of people don't like doing this one at all because it means leaving their family and friends behind. But that's moving to a different area altogether. And we've seen some of our clients do this. We had a client last year sell their house in the GTA and move to Alberta and buy mortgage free. So Alberta has a lot of lower priced houses right now. Or you can just move out of your current city. If it's a city, you can move outside of the city and buy a lower priced home that way. That's going to afford you more home for the amount that you qualify for, just because homes are priced lower. Again, That's not really the best solution, but it is one of the 6 solutions here. So just going over the 6 strategies that we have for you today is 1, paying off your debt to be able to qualify for more mortgage. Number 2 is get a second job to be able to qualify for more home. Number 3 would be get a co-signer to be able to qualify for more home. Number 4 would be to have more down payments so you can get around CMHC rules, a minimum of 20% down. Number 5 would be to access a lender that has higher amortization periods so you can spread that loan over a longer period of time. And number 6 would be to move to a different area altogether. So those are some of the items you can use to get into the market today and just get into the market where you actually can afford a home and do that sort of thing. So moving on to some of the data that I have collected for us today in terms of the mortgage news that's available. What we have here is episode 102. So first thing today, let's see here. What do I have here? First thing today. All right. All right. So today we have the 5-year bond yield. So we'll take a look at this today. And for the 5-year bond yield, we see it's at 3.56% today, which is quite a bit higher than last week. It's been going up just slightly. And it's hitting that mark right now where we topped out in the summer of 2022 when 5-year rates did peak. So we'll have to keep an eye on this to see if 5-year fixed rates continue to either peak at the same point they did in the summer or if they will go higher. It's a really interesting time for mortgages because in the summer, the 5-year fix did peak at that time. It did drop a bit through the fall. And now we're in the middle of fall and it's peaking again. So we'll keep an eye on this on Canadian Mortgage Weekly. And if you're looking at getting pre-approved, if rates do go up further, this would be a great time to lock in that 5-year fixed rate before they move up any further and just get your mortgage locked in. So if you do find a house, you're ready to go. Okay. Inflation. So a lot of viewers are really interested in inflation. We're about to get the numbers for this past month, but inflation did peak at 8.1% in June. We did have inflation come down a little bit in July and August, which is currently at 7% for August. And with it being at 7%, that's really good. I mean, it's still happening, this inflation. We're not going to see prices go down anytime soon, but the rate in which prices are increasing is slowing down just slightly. So the Bank of Canada really wants to get that inflation rate down to 2%. And with the goal of being 2%, we could see rate increases continue on until we hit that 2% range. But right now, we're still at that 7%. We'll see what happens on our next episode. I hope to have the inflation numbers for September by then, so keep in tune for that. Inflation rate for the United States has also been decreasing for 2 months in a row, it peaking at 9.1% in June, now sitting at 8.3% for August. We don't have September data yet, but I'm hoping that inflation has come down just slightly more, but unless it hits 2%, I believe the Fed will continue to raise rates in the United States as well, which we could see Canada just following suit with that. We are closely tied with the US, and just to keep up with that without our currencies getting too far out of whack, we will probably end up raising rates if the Fed in the States raises rates. And that will probably happen with the inflation rate the way it has been. It's not slowing down fast enough by the looks of it. So the CDOR rate, which is a rate that I use to compare the metrics with the variable rate currently and the fixed rate and the prime rate, just to help us determine whether or not the variable mortgage rate is a good deal at the current time. So right now, the variance to prime is 1.09 based on the CDOR rate being 4.36% as of October the 12th. So with the variance to prime being less than 2%, with that, it means that the fixed rate and the variable rates are very close together. There's not a big advantage right now to take a variable rate if you're looking to save monthly costs, especially if rates continue to go up. We have a rate announcement coming on October the 26th, so it'll be interesting to see what happens with that. In the meantime, I use this metric to determine if it's a good deal to take a variable rate mortgage. And really, it's all into what your plans are for the next 5 years. Do you plan to have a lot of changes? Do you need the flexibility? Sometimes variable can be the way to go. I would really suggest you setting an appointment with me through the link below to be able to discuss your mortgage plans with all that involved. But right now, unless variable rates start coming down anytime soon, really the fixed and variable should be considered both equally based on the CDOR rate being where it's at. And looking at the Bank of Canada rate announcement, we have the rate announcement coming on October the 26th. It'll be released at 10 a.m. live. We'll be tracking that here on Canadian Mortgage Weekly Live. We'll have a pre-rate show starting at 9:45 a.m. in the morning to look at the data leading up to the rate announcement, as well as a live release of the Bank of Canada rate announcement on October 26th. We're 13 days away. Last time, the Bank of Canada did increase rates by 75 basis points. Right now, the Canada overnight rate is sitting at 3.25%, with prime rate just over 5%. So join me next week. And if you're thinking that rates are going to go down or up, please drop a comment below. I would love to hear your predictions on where rates are headed next here on Canadian Mortgage Weekly Live. I'd love to see your comments below on that. So average national house price. Let's take a look at this here, because I really have been tracking this, and as of last month, we did have a slight increase of 1.5% in the average house price. After peaking in February of 2022, we did have house prices drop for a few months in a row. And we also had a few articles come out, one by TD Bank saying house prices are set to drop 23% by 2023. And we've already seen a drop of 23% this year for the average national house price. And there's a lot of real estate agents and other mortgage professionals out there that are pumping videos saying that, as of this point, they're expecting house prices to continue going up because we've already hit that predicted point where house prices will drop to. So is this the bottom? Have we hit the bottom as of July of 2022? And are we going to continue increasing? I'm not sure. We'll have to see how the next rate announcement impacts everything. We could see the trend reverse again, or we could see this uptrend continue going forward. So as of August, we did see house prices increase 1.5% nationally on average. So that's episode 102. It's always great to be able to report this data here on Canadian Mortgage Weekly. And just to go over the top 5 things people can do, again, to afford more home in this market. As I mentioned, the stress test is out there. It's really not helping everyone get into a home these days. It's really limiting the qualifying people can do on a home. So the top 5 things that people can do, and again, watch the beginning of this video if you want to go over that in detail, is number 1, pay off debts. Things like car loans and consumer loans can really impact the amount you can qualify for. Number 2 would be second job. Second job can increase that income for you to be able to get into that home. Co-signing can add strength to your application and help you get into that home. Get 20% down so you can avoid CMHC rules and the way that they qualify for homes. Number 5, access lenders with higher amortizations. We have lenders up to 40-year amortizations right now. And number 6, which is a bonus one, is move to a different area altogether to access a lower priced home, whether it is outside of the city, a different city, or a different province. But other than that, we really appreciate you tuning into Canadian Mortgage Weekly Live, Canada's only weekly video mortgage news podcast here, broadcast from Orillia, Ontario, and we do mortgages all over Ontario. So if you're looking at getting some mortgage advice, click the link below, schedule an appointment with me today, or leave a comment below, or send me a private message. I'd love to hear what sort of mortgage problems you're dealing with, if I can help you get through those mortgage issues, and we can see what we can do for you then. And again, thanks for tuning in today. Join us next week on October the 20th at Thursday at 11:30 for our episode 103. I look forward to seeing you there. In the meantime, thanks for watching and have a great day.